Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Giles Gale, Head of European Rate Strategy, and I'm joined today by our global markets specialists, Jan Nevruzi and Ross Walker. So, Jan, I think we'll start with you in the US because we have just had the CPI release. It so often happens that big, important events coincide with Bondcast. Maybe you can just take us through that a little bit and your takeaways.
Yeah, sure. It sure happens that we record Bondcast right after the CPI. But this time I think I had enough time to digest it. And I should say there really isn't a clear answer and like, yes, it was very good or no, it was very bad. There are certainly good components within the CPI. I think I saw a few more silver linings than kind of like the first impression that I'm getting from either market reaction or, like the online sphere. But, so the headline component fell for the month by 0.1, core was up by 0.3, and a large portion, of course, of the headline is influenced by food and energy prices. Energy particularly was a significant drag. A couple of the key things that I think in this report I should point out, and what supported the strength in core was largely, and in fact, a pickup in shelter and rent. Both of those components increased by 0.8%, which is a little bit stronger than last month and kind of closer to their highs during this cycle. But I am not too worried about the shelter part. For one, we've already heard from Powell that he prefers to look at a measure that excludes that component. It's well understood that rental and generally shelter measurements in inflation lag the spot market data. And we will see a deceleration. Those numbers will come down because alternative rent trackers and housing trackers have started showing significant signs of weakness. So that will happen. It's just a matter of when, and it might not necessarily reflect what consumers are paying today. Second, something else that supported the strength was the medical care component. After falling for a few months in a row, and this is one of the things that we've discussed in previous Bondcasts, where the measurement resets kind of lead to almost like a year-long drag to the medical component. This month, we had a volatile hospital expenses section that pushed the index higher. So over the past few months, that we didn't have enough data. Now we have, the BLS didn't have enough data. Now they've collected enough data, and that whole volatile component pushed the index a little bit higher while dragging the previous months a little bit lower, when you kind of like apply retroactively. And what does that mean? The rebound in services was a little bit stronger than we expect, particularly the Medicare care part. But on the other hand, you have the goods within inflation, so like the core goods, I should say. Core goods prices keep falling. They were down 0.3% a month. So, the whole shift from goods into services that has been kind of like the theme for the second half of the year has fully materialized. And in fact, we're seeing deflation in used, not just used car price, but like generally goods prices. So, the headline number, we have deflation in the economy.
Okay, so if we cut through that detail, I guess, to what we really care about, which is the Fed, how does that leave you thinking about the upcoming Fed meeting? Is that more 25? I mean, I know that's where you were, but...
Yeah, I mean, that's what happens when we have about an hour gap between inflation and CPI. I can start brushing up on what exactly medical care was it that dragged it down, and probably 99% of the people just fast forward at that point. But for the Fed, we had 25 basis points for the February meeting. So this report specifically doesn't scream go in either direction, but it certainly allows the Fed to lean into the market pricing, which was going more and more towards 25 basis points. So it sure looks like that will be the case. We had from the Fed already two officials coming out saying they prefer the 25 basis point path. We had a Timiros article just in the journal now, as I was about to walk into this room, that kind of alluded that the Fed, this inflation report allows the Fed to tee up a quarter point hike in February. So if the market gives it to you, I think the Fed will take it, and it seems to fit with how we see the rate path evolving as well. We expect another 25, like a step down to 25 basis point for the next two meetings after that as well, which should bring us kind of like the range that the Fed had targeted, 5.25 eventually, and kind of pausing there for some time. So, overall, it's all but confirmed that the Fed might step down. We have a little bit more data coming into the month, but I don't think anything will be this substantial to kind of like alter the path from here onward.
Right. I mean, so I suppose that going into the number today, there was quite a lot of kind of everything up euphoria. And it might have been viewed, I suppose, as a little bit of a preemption of a better number, an even better number today, which clearly we didn't necessarily get. But it sounds, listening to you, like this is really just your views tracking. Does it change anything about how you feel about the Treasury market at the moment? I guess it'll set the tone for the next couple of weeks.
Yeah. So like one of the themes that we talked about for 2023 was this re-steepening of the Treasury curve and eventually lower yields. I should say further out the curve, think 10-year or 30-year point, the yields came down much faster than we thought. The path obviously towards lower yields is never very straightforward, but this rally over the past weeks has been really really amazing, and it does feel a little bit too fast where we are, particularly kind of that part of the curve. So we still expect some steepening, but that could come a little bit from like upward pressure yields in the long run. But that being said, that is just like very short-termist kind of like tactical thinking. Over the more medium term, we still we've changed our inflation path to show a lower number throughout the year. So like we've actually improved our outlook on inflation. And by improved, I mean expect lower inflation. So we're not really in a rush to kind of chase yields and say, well, actually they're going to retrace here, they're going to bounce back up. So we are kind of like, I guess I should say, reasserting our bullish view, and kind of don't want to say, well, faded here, it's probably going to go up. We do look for steeper curves, with most on Fed so pricing out of future hikes rather than kind of like a bear steepening of the curve. So look for 530 steepeners are still in play. Even anything past like the 3-year point should be, we think, susceptible to rallies. And today was a day where the 3-year outperformed, and we kind of expect that trend to continue into the later part of the year. So I think that's probably enough for the US, and I'll spin that right back into you. And I finished off with the rally, so maybe you can pick up for Europe. The rally does continue, and how does that affect your views from across the pond for us?
Well, obviously we have been wrong about it so far this year. I think, one of the key points that we have to accept is that, clearly inflation sentiment is really what matters, and that has been in the driving seat in Europe as well. The indications have been better, both in the hard data. So we've had some lower CPI figures in Europe as well. Of course, remember that came out last week, just as we came back. And that's really sort of forming sentiment. I think that has been in the face of a lot of supply pressure. I guess we can come back to that. But I think for me, one of the main things just to consider is that lower inflation, particularly driven by energy prices, it all kind of feeds a narrative of economy bullishness as well. And so I think that one of the other important pieces of data was, for example, the European IIP, and it seems like recession, if we are in recession, well, it's a very mild one. Possibly it will be quite a short-lived one. Maybe we've avoided it altogether. So, and then I think, whilst that this lower inflation, sort of softer landing narrative, ought to feed a bit more of a sort of softer path assumption for the ECB. No, I still think that it leaves open this possibility that we have sort of follow-on rate hikes later this year. And I also think that it undermines one of the key sort of bullish arguments for longer term forwards, which was that central banks were going to crash the economy, and therefore everybody would be scrambling for duration before too long. So overall, I don't see it as especially bullish fixed income, and I certainly don't really subscribe to this bullish flattening that we've been seeing.
So you mentioned bond supply, but lower energy prices also impact the need for bond supply and the pressure from that. I don't know. What do you think about the relationship between that drop in energy prices and pressure due to supply?
Yeah, I mean that's been a question that we've been asked probably. I've frankly lost count of the number of times this week, because I think given the strength of the rally, people are questioning their assumptions, the assumptions with which they started the year, naturally enough. And one of them was that we were going to be overwhelmed by supply, and of course, lower energy, it's lower inflation, but a large part of the fiscal effort next year is going to be about energy subsidies. Honestly, I think actually, you learn more in a sense from the fact that people are so worried about asking this question than you do when you hear the answer, because we haven't had really the time, and I mean, I honestly don't know who would have the time to do a proper kind of bottom-up analysis of all of this, other than an analyst perhaps at the commission or something like that. So we went and looked at their assessment from the draft budget reports and so on, and basically you might be surprised to know that the total fiscal effort behind energy support measures next year, or this year I should say, is actually projected to be a little bit lower than last year, in part because a lot of countries had not really budgeted for a full year of support, which I think markets might reasonably have questioned. But the base case, really, if I just get down to brass tacks here, is that it might mean around 60 billion. That's with a lot of uncertainty, that's sort of middle of our range. So our base case about 60 billion less supply. So that if you want to put that into context, I mean, we've been talking about a supply shock in the sense of total investment grade bond sales this year to be absorbed by the market compared to last year of about 700 billion. That's the figure that I would have used in Bondcast towards the end of last year. Maybe it's tracking closer to 600 billion now, but that's still a pretty big shock, I would say. So I don't think that the theme is the wrong one still. And around that, I think that there are not only uncertainties about the way that you come up with this kind of number, but also there are other uncertainties around the execution and risks. For example, how confident are we that the energy quotes will stay so low? Will the ECB take advantage, like the risk of market disruption around supply is somewhat lower. Maybe governments to some extent sort of repurpose the effort that they budgeted for fiscal support around energy to trying to bring forward some of their energy transition plans, things like that. So I do think that there is so much uncertainty that really we shouldn't get too hung up on what in the scheme of things is not a huge number, I would say.
Yeah, that all makes sense, and I guess this is a consistent theme in how we're conducting Bondcast. But I should ask, with the lower inflationary pressures, where does that leave your view on the ECB?
Yeah, I mean, I can answer that pretty quickly. We still think 50, then 25, then 25. Yesterday, there was a market news piece out, which honestly I don't think we should be putting all that much weight on, but did get a little bit of attention just because it was. I mean, sometimes these things kind of capture the market mood, I suppose, which suggested that maybe the ECB will should be more open to 25 in February. Listen, I mean that would be pretty against the guidance that we heard, of course, in that very hawkish December ECB meeting, and also, frankly, against a lot of the guidance that we've had since. But we've had. Notably, when they started this cycle with the 50 basis points and then 75 basis points, they have gone against their fairly strong guidance in the recent past. So I don't think we should rule this out, but for us it's still pretty strong base case 50 basis points. But then in March, I think that the markets are still too skewed towards 50. I think that we may well see a slowdown there as QT takes on the baton.
I guess when the facts change, so does the guidance, to paraphrase saying. But and finally, ECB had published an economic bulletin today. So anything interesting if you managed to already skim through the whole thing?
Yeah, I mean, skim through, I suppose. I mean, listen, there was a box on wages that was moderately interesting, that was actually pre-released earlier this week, and that actually seemed relatively sanguine, although there was a clearly an editorial effort to sort of insert something that was a little bit more hawkish and on message right at the end. But overall, the message on wages was actually a little, I would say, reasonably sanguine. And then there was a box on reviewing the EPP, and while I haven't had time to go through that in any real detail, there's a quite nice chart, if anyone wants to pull that up, of their estimate of the total impact on 2, 5, 10-year bonds due to APP and PEPP. It's quite interesting to see that they seem to be suggesting that if it weren't for all the total effect of all those programs, they seem to think that we might be at 10-year bunds with sort of 360, that sort of level. So worth just keeping in mind. Anyway, that's it from me. Ross, it's over to you now. Key data next week, particularly inflation, which you, I believe, think is going to edge down, but on the other hand, we've got wage inflation still rising. Perhaps you could just give us the details from all of that.
Yes, well, obviously, very important US CPI numbers this week, and I guess that will reinforce an expectation that the UK numbers come lower as well. Though I think it's worth bearing in mind the UK is lagging the US maybe by sort of 3 to 4 months in this process, partly just the general cyclical position of the economy, but also the nature of the regulated domestic energy prices in the UK tends to delay the pace, the speed with which those wholesale price developments feed through. But yeah, we think another fall. These are data for November. So headline CPI to tick down to 10.5 from 10.7. At this stage, it's mainly an auto fuel story. We've seen about a 5% decline in forecourt prices. I guess the risks for the headline number are probably, though, to the upside for these numbers, simply because food price inflation has still been rising quite sharply. And some of the surveys, for example, the BRC data showed in December quite a sharp pickup in food price inflation. Nevertheless, as we move into data for 2023, particularly in the spring, you run into very powerful base effects. Overlay that with the moves in wholesale gas prices that we're seeing, that will probably factor in more in the second half of 2023, but it will obviously push headline rates down relatively sharply this year. The core is a little bit more complicated. I would say some of the early retail sales data and retailer reporting over Christmas, nominal spend looks to have held up relatively well. Obviously, that's in large part a reflection of high spot inflation. But it does feel like we may have a little bit of near-term stickiness in the core. We have it stable at 6.3. I always think December is, unless we're in a sort of full-blown crisis, it's never the obvious point for a lot of the retail sector to be engaging in aggressive price discounting. So it may be another month or two before we start to see the core coming down a little bit more decisively.
Okay, well, very clear. And so how do you think that the MPC is going to be balancing this then?
I think the interesting thing is, I mean, the MPC, when you look at the data, the actual data outturns, and even the MPC's commentary around the data, it's not obvious that anything has really changed that dramatically since the back end of last year. Yet, in terms of the actual data outturns, yet the MPC, the commentary is becoming a little bit more dovish, or at least markets are interpreting it that way, and thus far there's been no pushback whatsoever from policymakers. I think if you take that sort of Hugh Pill speech last week, there was some hawkish content. He talked again about the MPC is still on the lookout for evidence of persistent inflation. They may still need to act forcefully. There's still labour market tightness, et cetera, et cetera. But what really seems to drive markets and get the sort of media attention around this are the comments that, well, maybe the labour market's now turning, some of the more forward-looking data, some of the hiring difficulty indices are starting to ease. And so maybe there is a sense that, and this has been one of the complications with UK monetary policy, there is such an extended lag at the moment between bank rate policy rises and those rate rises reaching the real economy, particularly through the mortgage market channel, which is still the most powerful single transmission channel for the UK. It's hard to know when they've delivered enough. We feel, and we felt, the thing that's guided our relatively dovish view on the BOE has been that even today, in terms of the mortgage market, maybe only about a quarter of the 2022 bank rate rises have actually reached mortgage borrowers. So the bulk of this tightening that has been announced is still to work its way through. And so it's difficult to be overly definitive about whether they've delivered enough tightening. But I think there is a sense that they are becoming more cautious. And it was interesting this week, the Financial Conduct Authority was warning about rising potential stress, payment arrears in the mortgage market. So we saw the BOE tread a little bit more carefully after the Liz Truss Kwasi mini budget. I think all of this is reinforcing this notion that we're probably not too far away from the peak in rates.
So maybe I can just get you to boil that down to a punchline for us. When and where then for this peak in rates?
4.25 March. That concise enough. I don't think I can do it in fewer words than that. So we still think 50 in February, though the market, I mean, we've got about 41, 42 basis points priced. So that sort of half-point expectation around February is getting diluted a little. We stick with 50, a final quarter point rise in March. It may come a little bit later, perhaps May, the next quarterly forecast round, but it feels like they're not going to have to go a lot higher than that, at least for now.
Okay, thanks very much, Ross. Well, okay then, folks, that's all we have time for today. Thank you all for listening. I do hope you've enjoyed today's episode of Bondcast. Just make sure that you hit subscribe so that you can get the latest episodes as soon as they're available, and hit the like button so that it's easier for others to find. Thank you.